Welcome to the battle of the ETFs. Today we're going to put in the ring the very popular SCHD versus a new ETF called MOAT, M-O-A-T. Now I saw a Seeking Alpha article headline and decided to blindly do my own comparison, so I have not read the article. I don't plan on doing so. In fact, I don't subscribe to Seeking Alpha and I don't plan on paying for that. I also did not want to go into this with any bias from that article, so this is all from my own research, analysis, and opinions. Now, before we dive into the details, let's first look at my portfolio performance. This is something that I share with every video. It's my promise to you. I want to be honest. I want this to be an honest channel, so if you like that type of content, be sure to subscribe. Right now, I'm up 12.85%. It's doing very well. You will see in the bottom left, there's SCHD. I do hold that ETF myself, and it's up 8.28. For the long term, I think this will be a big win for me when it comes to passive income. Now let's get into this video, and we're gonna start with the ETF MOAT, and we're gonna spend a little bit more time covering this one because I've done videos on SCHD a few times, and I think it's a popular one that many will know about. So MOAT, its investment manager is called Van Eck, and it utilizes Morningstar, a financial services company, to pick its holdings. Now, Morningstar is popular in rating stocks and ETFs and something that many investors utilize. Now, MOAT's prospectus stated objectives are, this investment seeks to replicate as closely as possible before fees and expenses the price and yield performance of Morningstar Wide Moat Focus Index SM. The fund normally invests at least 80% of its total assets in securities that comprise the fund's benchmark index. The index is comprised of securities issued by companies that Morningstar determines to have sustainable competitive advantages based on a proprietary methodology that considers quantitative and qualitative factors, basically wide moat companies. So a few highlights on this. Wide moat companies, it's a focus on US companies Morningstar believes possess sustainable competitive advantages or moats. And the focus is on valuations as well. So the index targets companies trading at attractive prices relative to Morningstar's estimate of fair value. And they have a lot of research that goes into this. They have over 100 analysts globally that kind of rates these companies and gives them that small, medium, or wide moat rating. So that's what this fund kind of is at a high level. Now, if we look at the distributions and expenses, you will see it does pay a dividend and it hovers about 1%. So that's not too bad, especially if this provides growth, which we will test in a little bit. Now, the expense ratio is high. It's at a 0.46%. The average passively managed ETF expense ratio is 0.16%. The average actively managed mutual fund is 0.47%. MOAT is passively managed, but has the expense ratio of an actively managed fund. I do not like this. This is expensive, and I think it might be more expensive because they're still utilizing Morningstar, which does utilize analysts, but still, it's passively managed by the investment manager. So does the performance of this ETF make up for it? We will see here in a second. Let's look at the top 10 holdings of MOAT. Again, this ETF is all about a wide moat, having wide moat companies. So I look firstly at TransUnion. They're number 1 in Equifax, which is the number 5 down below. They are credit reporting agencies. It's where you can find your credit score, and I agree that these companies have a wide moat as they are 2 of the 3 big credit reporting agencies. The other is Experian. They are in a triopoly, and that's a competitive advantage, and I like that this fund holds 2 of the 3 biggest. As long as a company is in the top 3, I consider that a part of having a wide moat. A duopoly is better, and a monopoly is best. Google and Salesforce, I can also agree with having wide moats. The other top 10 are ones I have not heard of or don't know much about, so I randomly picked 2 just to see if they have wide moats or not. We're going to start with Tyler Technologies. Now this is in the IT sector and the industry is software. Now Tyler Technologies provides integrated information management solutions and services for the public sector. It operates in 2 segments, enterprise software and platform technologies. The company offers financial management solutions including modular fund accounting systems for government agencies or not-for-profit entities, utility billing systems for the billing and collections of metered and non-metered services, products to automate city and county functions such as municipal courts, parking tickets, equipment, and project costing, animal and business licenses, permits and inspections, code enforcement, citizen complaint tracking, etc., etc. Basically, it's heavily involved with the government again, that public sector. And at the very bottom, you can't see this in the explanation, but it says it has a strategic collaboration agreement with Amazon Web Services for its cloud hosting services, which makes me happy because I invest in Amazon. It's one of the holdings in my portfolio and I'm very bullish. That's a whole nother video. But again, what makes a wide moat? I talked about the triopoly, duopoly, or monopoly. So what is the top government software vendors out there? I found this, and Tyler Technologies surprisingly was at number 2. Microsoft does have the lion's share, and this is a crowded field, but Tyler Technologies is at that number 2, and that shows me it does have a wide moat. I think the government is less likely to switch vendors as change is slow with the government, so I think they are safe and can grow their market share, especially with how the government looks negatively at big tech usually, aka Microsoft in this example. So yes, Tyler Technologies has a wide moat. I do agree with that. The next one I decided to pick on is Zimmer Biomet Holdings. Now this company, they're in the healthcare sector, and the industry is healthcare equipment and supplies. Now, they, together with their subsidiaries, operate as a medical technology company in many countries around the world. So I decided to look at the top medtech companies by revenue, and you'll see here, it's not in the top 3 like I like. It's not in the top 5, top 10, or top 15. It's in the top 20, and it's barely there at number 19. And you'll see it has the 6.8 billion revenue versus all the others that have much more revenue above. So I don't see the competitive advantage with this company. I looked and saw no news of any acquisitions that maybe they want to include it in this fund because it might be acquired by a larger company. I don't see why this ETF considers this a wide moat company. I think they have this one wrong. But if you know something special about this company that might say otherwise, please let me know. So yes, this fund is holding companies that I also agree have wide moats with the exception of Zimmer Biomet, but be warned that Morningstar has gotten it wrong in the past. They had Apple as a small moat company for a very long time, and only recently, I think within the last year, year and a half, did they update it to a wide moat, where I think it's been a wide moat for a very long time. So I think they guided investors incorrectly here. So you just need to be sure to do your own research and due diligence, and don't just go off of what anybody else or company says. So regarding moat, how has its returns been? We're going to compare it to the S&P 500, and we're going to look at moat's net asset value return. That includes those expenses, that net expense ratio. So over the 1, 3, 5, 10, and life of this, we're taking the average. It beat on all of those compared to the S&P 500. So it's outperforming the S&P 500. That's something I like to see. The wide moat strategy is working in this context. Now, the sectors it's mainly exposed to are the IT, healthcare, financials, and industrials. And so again, I think overall, this is proving to be a true wide moat ETF. And in the end, you want to stick around after we go over SCHD now. I'm going to do some interesting comparisons and pick the one I think is best. Now, SCHD, the investment manager is Schwab, and the investment seeks to track as closely as possible before fees and expenses the total return of the Dow Jones US Dividend 100 Index. To pursue its goal, the fund generally invests in stocks that are included in the index. The index is designed to measure the performance of high dividend yielding stocks issued by U.S. companies that have a record of consistently paying dividends, selected for fundamental strength relative to their peers based on financial ratios. The fund will invest at least 90% of its net assets in these stocks. So some highlights: it has some tax efficiency, and it tracks an index focused on the quality and sustainability of dividends, where MOAT is the sustainability of those wide moats, the competitive advantages. And SCHD invests in stocks selected for fundamental strength relative to their peers based on financial ratios. So if we look at its distributions and expenses, we'll see it does obviously pay a much higher dividend yield at 3.58. So it's been going between the 3.5% to 4% range this year. Its net expense ratio is extremely lower than MOAT's. It's at a 0.06, where MOAT's was 0.46. So I really like that here. If we look at the top holdings for SCHD, we will see a lot of companies that we all recognize. And regarding MOATs, just to kind of compare it, I think we have some wide MOATs in here. I think we have some medium MOATs, and I do think we have some depleting MOATs. So the wide MOATs for me are Coca-Cola, Chevron, Home Depot, Pepsi, Broadcom. The medium moat is probably one like Cisco, and the moats that are deteriorating are ones like Verizon. I think they're losing their competitive edge. And so I'm going to look at something interesting with Verizon in a minute on another chart. But yes, I think overall they did really well except for Verizon. I like the holdings. I think they're sustainable. These companies are, successful, they're strong, they're of quality, except for Verizon. Now, if we look at its performance, we'll see that compared to the S&P 500, the one-year average, the most recent one, it's really underperformed. But other than that, it hasn't been too far behind. So I like to see that. And with its sector exposure, it's mainly in the industrials, healthcare, financials, consumer staples, and IT. So SCHD to me is a good fund for that passive income. It still provides that growth. They grow their dividend healthy. So yes, now let's compare these two ETFs. They're putting in the ring now. We're putting them in the ring. We're getting ready for them to fight. So I want to do something interesting here. I thought about this. I want to compare the top 10 companies with both these ETFs and compare their 5-year performance versus the ETF itself. So for example, let's look at MOAT. We're going to look at the 5-year performance again of MOAT and then its top 10 holdings. So MOAT over the last 5 years is up 79.82%. So for example, if we go down the top 10, TransUnion, the stock by itself is up 6.09% over the 5 years, so kind of an underperformer. Tyler Technologies is up 71.44%, so it's done good. Zimmer 5.46, so on and so forth. I highlighted two, Viva and Alphabet, which is Google. Viva is up 148.96% and Google is up 108.12%. Both of these companies outperformed MOAT over the last 5 years, where the others underperformed MOAT. So 2 out of the 10 have outperformed MOAT. So that might tell you something where maybe MOAT is a little bit overbought, overvalued compared to the holdings that it has. So now let's look at SCHD. SCHD over the last 5 years is up 44.33%, and you'll see 6 of the 10 holdings have outperformed SCHD, which is a good sign. But there is one negative, that darn Verizon. It is down 35.94%. I don't know why SCHD is holding on to this company. I think that it is just a stock that continues to go down in value. I think its dividend is at risk of being cut, a small risk, but it is at risk. So I'm curious to see what the reshuffling of their holdings are over the next couple of quarters. But overall, I think this kind of shows with those 6 that have outperformed SCHD, maybe SCHD is more undervalued and at a better valuation and buying opportunity. So with that said, MOAT has run up a lot, and we might see that slow down compared to SCHD when we look at the performance, the 5-year performance of all these holdings compared to the ETF itself. Now, a quick comparison, because we went over a lot, I want to review it once more. We'll see the PE ratio. This one wasn't covered, but I looked it up. For SCHD, it's a 13.96, so to me that's undervalued compared to MOAT's 24.71. When you look at the average out there of the markets, I think SCHD is at a good valuation. It's at a good buying opportunity when looking at its PE ratio. The dividend yield, of course, SCHD is going to be higher. I think that could be more attractive, especially with the bond yields right now, but it's still good, and they grow their yield pretty good, pretty healthy year over year. MOAT's is a 1%, which isn't bad if you're looking at more of a growth stock ETF type of fund. The expense ratios are where I have a very strong opinion. SCHD is at 0.06. MOAT's is extremely high at a 0.46 for a passively managed fund. Though they utilize Morningstar, which does have analysts, I don't think that justifies that high of an expense ratio. Again, though, the performance of MOAT has been really good. Now, the 1-year return is where we see the big difference, but other than that, SCHD isn't too far behind. And when you incorporate the dividends and the reinvestments of those, this would look different. It would tick SCHD higher than MOAT, so I think that would put them a little closer. But yes, this is the quick comparison, and now I want to provide the summary. MOAT. It's an ETF geared towards growth because it has the wide moat. We saw the companies, we've seen how this has performed, versus SCHD, which is geared more towards income, that nice passive income from those dividends. So for me, just looking at MOAT, I would not invest in MOAT due to their high expense ratio. I'd rather invest in an S&P 500 ETF that has a much lower expense ratio and still will carry wide moat companies. That's why it's the S&P 500. They carry the largest 500 companies on the stock exchange, and that to me signals a wide moat in most circumstances. Now, if I had to pick between MOAT and SCHD, I would choose SCHD currently, as I think it's at a better valuation compared to its holdings and has been suppressed due to the higher bond yields, making those more attractive. But when those bond yields start to decline, you bet investors will flood back into SCHD. So I think it's offering a prime opportunity right now before it rockets back up to all-time highs eventually. So now MOAT, I think, has rode this growth stock rising tide and is more risky, as that tide can and will most likely turn at some point. So SCHD is the pick for me. And I would like you guys to let me know your thoughts, which ETF you think is the current better investment, and any other opinions you may want to share. I hope this was a fun video, and I'm very anxious to hear who picks SCHD, who picks MOAT. Again, the main factor for me is that expense ratio. Over time, that will eat at your gains. And just the market we're in, I think SCHD is poised for a recovery more so, and MOAT has that risk of being stagnant or actually decreasing in value, having some struggles. So thank you for watching. I hope you guys have a great day, and see you soon.